Welcome to the Deep Dive, your shortcut to being genuinely well-informed. Let's be honest, diving into the world of investing can feel, well, it can feel like wading through thick fog.
Right, absolutely. So much jargon, uncertainty.
Yeah, and advice coming from everywhere. How do you
Right.
cut through all that noise and, get to what truly matters without getting completely overwhelmed?
Such a real challenge.
Well, that's exactly our mission today. We're going to distill some powerful, practical, and surprisingly accessible investment strategies. These aren't just for the Wall Street pros. These are tools that can really help you build wealth and, frankly, reduce a lot of financial stress. Today, we're taking a deep dive into two incredibly potent yet often misunderstood strategies: dollar cost averaging, DCA, and employee stock purchase plans, ESPPs.
And you're going to walk away from this deep dive with more than just, definitions.
Yeah.
We'll give you a clear understanding of exactly how these strategies work, the surprising benefits they offer, and the specific details you need to know to potentially put them to work in your own financial life. We're talking actionable insights here, things that could genuinely make a tangible difference.
Okay, let's do it. Let's begin with dollar cost averaging, or DCA. It's a remarkably simple concept at its heart.
It really is.
It just means you commit a fixed amount of money to an investment on a regular schedule, consistently, regardless of what the market price is doing at that moment.
Yeah.
The whole point is consistency, right? Not trying to play that impossible game of timing the market.
Exactly. And to illustrate how DCA works, let's just picture this.
Mhm.
Say you have $1,000 you want to invest. Instead of, throwing it all in at once, maybe you decide to invest $100 every month for 10 months.
Makes sense.
Now, some months the stock price might be high, so your $100 buys fewer shares. But other months the price drops, and that same $100 buys more shares.
Yeah.
The beauty of this is that over time, this practice tends to lower your average cost per share. Why? Because you're automatically accumulating more shares when prices are low.
Got it.
And what's really interesting here is that many of you listening are likely already using a natural form of DCA without even really thinking about it.
How so?
Well, every time your 401k or maybe your IRA contributions come straight out of your paycheck, regularly.
Oh, right. Yeah.
That's classic dollar cost averaging in action. You're already doing it.
That's such a brilliant point. It's something many are already benefiting from. But beyond that automatic action, what really makes DCA such an effective strategy, like for simplifying investing and taking the emotion out of it? What are the biggest problems it solves for us everyday investors?
Well, it tackles two of the biggest roadblocks investors face head on. First, it genuinely reduces timing risk.
Okay.
Trying to pick the absolute perfect moment to invest a large sum is, well, frankly, it's almost impossible. Even the pros struggle, right?
Yeah, good luck with that.
DCA just bypasses this entirely by ensuring consistent investment. It sort of smooths out the market's natural ups and downs.
Yeah.
And that consistency is basically your protection against making a big lump sum purchase right before, an unexpected market drop.
Okay. That makes a lot of sense. What's the second thing?
Second, and this is just as important, it eases emotional investing. We've all felt that tug, haven't we?
Oh, yeah.
That fear that makes us hesitate when prices are falling,
Yeah.
or the greed that tempts us to jump in right at the peak.
Totally. FOMO.
Exactly. DCA gives you a set plan, a clear directive, so you're less likely to let those powerful emotions dictate your decisions. You invest whether the market is up or down. It effectively combats what some people call analysis paralysis, or worse, making impulsive bad moves like panic selling when things look scary.
Right. Sticking to the plan.
Precisely.
Yeah.
And thirdly, it helps build habit and discipline. Setting up those regular investments, it's like paying yourself first automatically, consistently.
Yeah, it's key.
This steady, almost invisible accumulation of assets over time, that's fundamental to long-term wealth building. And finally, because you're consistently buying, you naturally tend to achieve a lower average cost per share.
Okay.
Because when you're scooping up more shares during those market dips, your overall average purchase price becomes lower than maybe the average market price over that period, which can really boost your returns when the market eventually recovers and climbs.
That deeper dive into the why really connects the dots. Could you maybe give us a concrete example, something that highlights that lower average cost benefit?
Certainly. Let's stick with that $500 idea. Say you invested over 10 weekly installments of $50 each.
Okay. $50 a week.
And let's say the stock price fluctuates.
Yeah.
Maybe it goes from $10, then dips down to $8, jumps up to $12. and settles at $11 per share.
Yeah.
It bounces around.
Our normal market stuff.
Over those 10 weeks, you might end up accumulating roughly, let's say, 47.7 shares in total. Your average cost per share in this scenario would be about $10.48. Now, compare that. What if you had invested the entire $500 as a lump sum on, say, week 4, when the price just happened to be $11?
Right. Just one shot.
In that case, you'd only get 45.45 shares.
Oh, fewer share.
Exactly. The real takeaway here is how that consistent buying, even in a choppy market, can effectively give you more shares for your money in this kind of scenario.
That example really clarifies the mechanics. So for listeners weighing this up, when is DCA most useful? And are there any nuances we should be aware of?
Good question.
It's particularly useful for beginners, absolutely. And for anyone who's investing regularly from each paycheck, it's a fantastic way to automate things.
Definitely. Set it and forget it almost.
Pretty much. But it's also a smart move if you suddenly get a lump sum, like a bonus or maybe an inheritance, and you feel a bit nervous about dropping all that cash into the market at once.
Yeah, that can be daunting.
Right. So you could deploy it using DCA, maybe invest, say, 1/6 of it each month for 6 months. It acts like a hedge, mitigating the risk of putting all your money in right before a potential downturn.
Okay.
Now, here's a crucial nuance, though. If the market just steadily rises throughout your entire DCA period,
Right, no dips.
then yeah, a lump sum investment right at the very beginning might have actually performed better. And statistically, markets do tend to rise more often than not over the long term.
That's true.
But I think many of us view DCA as a kind of insurance policy against those unpredictable short-term crashes. It offers peace of mind, reduces that downside risk, even if the potential upside might sometimes be slightly lower than perfect timing.
That's a vital point to remember. DCA isn't some kind of magical strategy that guarantees profit or, protects you from loss in a consistently declining market.
Right, it's not foolproof.
No. If prices just keep falling and falling over your whole investment period, you'll still lose money on paper, although you would be buying progressively cheaper shares, which helps later. Its true power lies in reducing risk and providing that emotional comfort. It ensures you participate in both market upturns and downturns without the impossible burden of needing to predict them.
So it lets you take advantage of the dips without freaking out.
Exactly. You buy low automatically, and you steadily participate in the upturns.
Okay, we've covered the broader market with DCA. Now, let's zoom in on a powerful, often missed opportunity hiding in plain sight for many employees. Employee stock purchase plans. ESPPs.
Yes, ESPPs. These can be a truly fantastic workplace benefit.
How do they generally work? Break it down for us.
Okay, so you opt into your company's plan, and you choose to contribute a percentage of your after-tax paycheck. Often there's a maximum, maybe 10–15% of your salary.
Your tax.
Right. These funds then accumulate during what's called an offering period, which is commonly 6 months long.
6 months, got it.
Then, at the end of this period, on a specific purchase date, your company uses all your accumulated funds to buy shares of its own stock for you.
Okay.
And here's the significant perk. You purchase these shares at a discounted price, typically up to 15% off the market price on that day.
15% off. Nice.
It is, but what makes many ESPPs truly exceptional is a feature called a look-back provision.
A look back. What's that?
This means the purchase price could be based on the stock price at the start of the offering period or the price at the end of the offering period, whichever one is lower.
Whoa, wait. Whichever is lower.
Whichever is lower, minus that generous discount. So think about it. If your company's stock price has risen significantly over that 6-month period,
Yeah.
you get an even better deal because you're buying at a discount off an earlier lower price.
Okay, that look-back provision sounds genuinely game-changing. Can you break down just how significant that is? Like, how does it create an instant gain?
It really is. Think about it. Getting a 15% discount on a stock effectively means you have an immediate, it's like a 17.6% paper gain the moment you buy.
How's that math work?
Well, if the stock is trading at $100 on purchase day and you only pay $85 for it,
Right, 15% off.
you've essentially gained $15 on an $85 cost. That's a 17.6% return right there. $15.85.
Wow. Okay, that's why people call it free money.
Pretty much. It's a built-in profit from day one. It offers a substantial cushion against any minor stock price drops that might happen right after you buy. Honestly, it's one of the best deals an employee can typically get.
Okay, makes sense. What about the practicalities, limits, schedules?
Right. So the IRS sets a maximum for qualified ESPPs. You can purchase up to $25,000 worth of stock per calendar year. valued at the market price on the first day of the offering period.
25,000. Okay.
Now, your company might also have its own limits, usually a percentage of your salary period, like that 10 or 15%. For most average employees, hitting that $25,000 ceiling isn't common, but the company limit might be easier to reach. Plans typically run on a set schedule, like 2 6-month cycles per year, maybe with purchases in June and December, or sometimes quarterly. You enroll during an open window, you set your contribution rate, and the deductions happen automatically from your paycheck after taxes.
And the shares just show up.
Yep. The purchase shares are then usually deposited directly into a brokerage account set up for the plan.
All right, let's tackle navigating the tax maze for ESPPs. This is where it can feel a bit complex, maybe, but let's try to boil it down to the essential decision for you, the listener.
Okay. The good news first. You generally don't owe tax on the discount itself at the exact moment of purchase.
Phew, okay.
Taxes only come into play when you sell the shares.
Okay, so selling triggers it. What's the deal then?
Here's the core trade-off. If you decide to sell your shares quickly, generally, that means less than 1 year from the purchase date and less than 2 years from the start of the offering period, that discount profit you got. It's typically taxed like your regular salary.
Ordinary income.
Exactly, ordinary income. Any additional profit beyond that discount is then also taxed as a short-term capital gain, usually at those same ordinary income rates.
Okay, so sell quick, pay more tax on the discount part. What if you hold longer?
Right. Now, if you hold the shares for longer, meeting specific criteria, typically at least 1 year after purchase and at least 2 years from the offering start date.
A qualifying disposition.
That's the term, yes. The discount portion is still generally taxed as ordinary income, but critically, any remaining gain on the stock, the appreciation above the discounted price, could be taxed at potentially lower long-term capital gains rates.
Ah, lower rates. That's the potential benefit of holding.
Precisely. So the decision for you is, do you lock in that sweet built-in profit immediately, accepting the higher ordinary income tax rate on the discount? Or do you hold on for those potential lower long-term capital gains tax benefits?
Which means taking on risk, right?
Exactly. Holding longer means taking on the risk that your company's stock price might fluctuate, maybe even go down, for a longer period. It's a classic risk-reward calculation, and it's very personal.
That makes sense. It's a clear choice, even if the details are tricky.
And that leads perfectly into some key risks and considerations beyond taxes. While ESPPs are incredibly beneficial, remember you are investing in a single stock.
Your employer's stock.
Right. And it's the company that also pays your salary. This creates kind of double exposure to one firm's fortunes. So it's generally wise not to become over-concentrated. You don't want all your financial eggs in that one company basket.
Good point. Diversification still matters.
Absolutely. And while that immediate discount provides a buffer, the stock price can still drop significantly. It could potentially erode or even wipe out your discount entirely if the drop is steep enough right after purchase.
So it's not guaranteed profit if the stock tanks.
Correct. Also, remember, the money you contribute to an ESPP is after tax, and it's tied up during that whole offering period, maybe 6 months. So you need to ensure you're not committing funds you might unexpectedly need during that time.
Okay, so which companies offer these kinds of plans? Is it common?
It's quite common, especially among large publicly traded companies. Think Apple. They often have a 15% discount and that valuable look-back provision, allowing generous contributions.
Okay, Apple. Who else?
Microsoft frequently offers maybe a 10% discount with quarterly purchases. Other tech giants like Salesforce, Adobe, even Tesla, they often provide those sweet 15% discounts, usually with semi-annual purchase periods.
So big names do this.
Yeah, and these examples illustrate the power, especially with a 15% discount and a look-back. The worst-case scenario is generally that you buy shares at 85% of whatever the lowest price was during that 6-month offering period.
So even if the stock fell, you still got it 15% cheaper than its lowest point in that window.
Usually, yes. That's the beauty of the look-back combined with the discount. And the best case, of course, is that the stock rose significantly, and you're buying at a 15% discount off that old, lower starting price, yielding an even more substantial immediate gain on paper.
Wow, okay. That really frames the upside.
Given these scenarios, maximizing ESPP benefits is often quite clear. The common and frankly often recommended approach, especially if your plan has both a look-back and that maximum 15% discount,
Yeah.
is to contribute the most you can comfortably afford. Then, what many employees choose to do is sell the shares immediately or very soon after purchase.
The sell immediately strategy.
Right. This effectively converts the ESPP benefit into a reliable cash bonus, roughly that 15% or so gain on your contributed amount, minus the taxes you owe. You can then take that cash and reinvest it elsewhere to diversify or just use it as needed.
So you lock in the gain right away.
It's exactly. The alternative, holding the stock long-term, really only makes sense if you have extremely strong conviction in your company's future prospects. And even then, you have to remember those tax holding periods and the inherent risk of holding too much individual stock.
Right, the concentration risk again.
Which really raises an important question for anyone with access to a good ESPP. Why would you leave that kind of clear, immediate profit opportunity on the table? That discount truly makes ESPPs one of the absolute best, lowest risk deals available to employees.
What a deep dive. Okay, we've covered a lot today. We talked about dollar cost averaging DCA as a disciplined, emotion-free way to invest for the long term. Helps you build consistent wealth without the headache of market timing. And then we broke down employee stock purchase plans, ESTPs, which sound like powerful built-in profit opportunities offered right there by your employer if you're lucky enough to have one. So what does this all mean for you listening?
Well, it means these aren't just theoretical financial concepts you read about. These are practical, accessible tools designed for real financial growth. Understanding, and maybe more importantly, applying strategies like DCA, and really taking full advantage of an ESPP, if it's available to you, that can significantly strengthen your financial foundation.
Yeah.
It helps you work towards your wealth-building goals, and honestly, it removes a lot of the guesswork and those emotional pitfalls that can derail even the most well-intentioned investors.
Absolutely. Both DCA and ESPPs really highlight a core investing principle, don't they? Consistency and just taking advantage of opportunities, even seemingly small ones like a discount, can lead to substantial wealth accumulation over time.
That's the key takeaway.
So the question for you is, where can you start applying these powerful principles in your own financial journey? And maybe think about this. What other easy money opportunities like that ESPP discount might you be overlooking in your own life? Something to chew on. Think about it, and we'll catch you on the next deep dive.